All right, welcome back to the iWealth podcast. I'm with Shawn Pomeroy from our Waseca iWealth office today. He's an advisor there that does a great job for our clients. And Shawn, I wanted to talk to you about, it might sound boring because it's a Roth IRA and we all hopefully know what a Roth IRA is, which is a tax-free investment. I mean, at the end of the day, the growth is tax-free. Okay, I said it right. But I wanted to ask you a question regarding Roth, like who's the ideal candidate? Do you get to a spot where you're too old and you shouldn't do a Roth? Like when you think of Roth IRAs and you think about the clients you serve and take care of, who does it fit for?
I think it fits for everybody. Now, if you back that up and you say, are you going to pay more taxes later than today? There's certain metrics that we would use financially to decide whether or not the Roth is going to make tax sense. Mm-hmm. I'd say that the issue that I have is a lot of my clients who are retired, we're used to paying income tax on income.
Yeah.
What we're not used to paying tax on is going and buying something. So we've got sales tax. You want to supersize that sales tax? Go ahead and withdraw that money from your IRA, pay tax on that, pay maybe some tax on your Social Security, and now walk in with a lot smaller check to go buy what you want to buy.
So let's back into that. So again, I'm going to buy a car.
Yep.
I'm retired and it's a $30,000 car. Explain to what do you mean when you say supersize your taxes? What do you mean by that?
So you're going to pay sales tax on the car, right?
Yep.
We all know that.
Yeah, and I do that.
Depending on your state.
Yeah.
Right? So now if you come in and you say, Shawn, I need $30,000.
Yeah, I'm going to buy my car.
You're going to buy your car. You're going to pay cash because you don't want to pay that interest rate. I say, all right, Brad, based on your normal income and your Social Security, I think we need to withdraw quite a bit more than that so I can give you $30,000. We've got to take care of the federal tax on that withdrawal.
Okay.
Maybe you're in the 12% bracket. Maybe you're in the state of Minnesota and you're getting somewhere near about 7% tax, 6.5%, 7%. Mm-hmm. Looks a lot like 19%.
Mm-hmm. Mm-hmm. So you have to take out 19% more.
Yep.
So all of a sudden you're taking out 40,000 or 43 or whatever the math is.
Yep. Now what if you have Social Security income?
Okay.
And last year you didn't have to pay any income tax on that because you were right at that point where your income was a sweet spot, didn't owe the government any income tax on your Social Security. Mm-hmm. What do you think happens when you take this $30,000 out?
I think you're going to tell me I pay taxes on it.
Yeah. They're gonna count a whole bunch of it. Maybe up to 85% of your Social Security all of a sudden becomes taxable.
So let's say I have $30,000. Let's use $40,000 a year in Social Security coming in. A piece of that now gets added to my 1040.
Correct.
And I pay tax on that as well.
So that $30,000 withdrawal just all of a sudden acted like maybe 60. By the time we add on the taxes, it's a big swing. That Roth takes care of that.
One more thing though, for a second, Medicare. Medicare is another one. The Medicare premium you pay, when you have more taxable income, you have an additional premium potentially too, right, with the threshold. So that's another one that's in there.
Yeah.
So all these different taxes and things bundled in goes back to the question I set up to begin with which is why Roth and who and how does it fit? So go back to that.
That Roth gives you a place to save where we can take control of that future taxation of zero. Right? We've paid our tax today, we put it in there. So as we're working, maybe we use a portion of our 401k that we're going to be adding to if we have that in our, not all 401ks have Roth, but if we have that as a component, maybe we slide a few dollars into that. I'm willing to pay my tax on it today to build a future emergency bucket, build a future goal bucket of buying a car when I retire, whatever those things are.
Mm-hmm. Because the withdrawal out of the Roth is tax-free.
Correct.
Because you paid on it when you put it in.
Correct.
And you don't pay it on it when it grows.
I've eliminated surprise on that piece.
What's the caveat to get it tax-free in retirement, the Roth?
You got to have it for 5 years.
Okay.
So we had to have started a Roth 5 years before we want to make that withdrawal. And we've got to watch the gains. So if we haven't had it 5 years or under 59.5, the gains are what have that taxation and maybe a penalty on it for early withdrawal. Mm-hmm. But we get outside of that, 5 years, 59.5, no taxes on the principal, no taxes on the gains.
Yeah. So people need to people need to pay attention and not turn their head saying, I'm in a high tax bracket, I shouldn't do any Roth. Because then it goes back to tax brackets. Do you think we have any government debt? And do you think taxes could be higher 20 years from now than it is today? I tend to think that we're in the lowest brackets we'll be in. So, they just need to pay attention. Use their CPA, obviously, right?
Correct.
You work hand in glove with the CPA as well. So
It's just another bucket that we can put together to be ready for something, and it makes sense.
Yeah. All right. Well, thanks so much for your insight, Shawn. And thank you for tuning in to iWealth Podcast, and have a great day.